Hi, I'm Iggy from the Investing Iguana. In this video, I'm going to talk about the latest economic data from China and what it means for investors. China is the world's second largest economy and a major trading partner for many countries. Its economic performance has a significant impact on global markets and investor sentiment. That's why it's important to keep an eye on the key indicators that reflect China's economic health and outlook. Today, I'm going to focus on two of those indicators: producer prices and consumer prices. Producer prices measure the change in the average price of goods and services sold by manufacturers and producers. They are also known as wholesale prices or factory gate prices. Consumer prices measure the change in the average price of goods and services purchased by households. They are also known as retail prices or cost of living. Both producer prices and consumer prices are closely watched by policymakers and investors as they reflect the supply and demand conditions in the economy, as well as the inflationary pressures and expectations. So, what did the latest data show? Well, according to the National Bureau of Statistics of China, producer prices fell for the 52nd consecutive month in June, dropping 2.6% year-on-year, compared to a 2.8% decline in May. This means that China's industrial sector is still suffering from weak demand, overcapacity, and falling profits. The decline in producer prices was mainly driven by lower prices of raw materials, such as coal, oil, steel, and non-ferrous metals. These sectors have been hit hard by the global commodity slump and China's efforts to reduce excess production and pollution. The drop in producer prices also reflects the lack of pricing power among Chinese manufacturers and producers who have to compete with cheaper imports or cut costs to survive. Meanwhile, consumer inflation was unexpectedly flat in June, staying at 1.8% year-on-year, the same as in May. This means that China's consumer sector is still facing subdued demand and low income growth. The stability in consumer inflation was mainly due to a moderation in food prices, which account for about one-third of the consumer price index. Food prices rose 4.6% year-on-year in June, down from 5.9% in May, as pork and vegetable prices eased after a surge earlier this year. Non-food prices, on the other hand, remained weak, rising only 1.2% year-on-year in June, unchanged from May. Non-food prices include items such as housing, transportation, education, healthcare, and entertainment. These sectors have been affected by the slowdown in China's property market, the oversupply of cars and other durable goods, and the rising competition from online platforms and services. These data suggest that China's economy is still facing deflationary pressures and sluggish growth, despite the government's stimulus measures and monetary easing. Deflation is a situation where the general level of prices falls over time. It can be harmful for the economy, as it discourages consumption and investment, erodes profits and wages, increases debt burdens, and creates a negative feedback loop. Growth is a measure of how fast the economy is expanding or contracting. It is usually expressed as the annual percentage change in gross domestic product, GDP, which is the total value of goods and services produced in a country. China's GDP growth slowed to 6.7% year-on-year in the first quarter of 2016, the lowest level since 2009. The government has set a target range of 6.5% to 7% for this year. To counter the economic slowdown and deflationary risks, China's government has implemented various fiscal and monetary policies to stimulate demand and support growth. Fiscal policy refers to the use of government spending and taxation to influence the economy. For example, China's government has increased its spending on infrastructure projects, such as railways, roads, airports, and power grids. It has also reduced taxes for some businesses and individuals to boost their income and spending. Monetary policy refers to the use of interest rates and money supply to influence the economy. For example, China's central bank has cut its benchmark interest rate 6 times since November 2014 and lowered its reserve requirement ratio, RRR, for banks 5 times since February 2015. It has also injected liquidity into the banking system through various channels. These policies are intended to lower borrowing costs for businesses and consumers, increase credit availability for productive sectors, and encourage investment and consumption. However, these policies have not been very effective so far, as they face several challenges and limitations. Some of the challenges and limitations are the high level of debt in the economy, especially among local governments, state-owned enterprises, and property developers. This debt has been accumulated over the years as a result of excessive investment and borrowing, fueled by cheap credit and government support. The high debt level poses a risk of default and financial instability, and also limits the scope for further stimulus. The structural imbalances in the economy, such as the over-reliance on investment and exports, the underdevelopment of the service sector and domestic consumption, the income inequality and social disparities, and the environmental degradation and resource depletion. These imbalances have been caused by China's growth model, which has prioritized rapid expansion over quality and sustainability. The structural imbalances require deep reforms and adjustments, which may be painful and disruptive in the short term. The external uncertainties and pressures, such as the weak global demand, the volatile commodity prices, the rising trade protectionism, and the geopolitical tensions. These factors have affected China's export performance, foreign exchange reserves, currency stability, and international relations. They have also increased the complexity and difficulty of China's policy making. What does this mean for investors? Well, it means that China's central bank may have more room to cut interest rates or reserve requirements to boost liquidity and support growth. It also means that investors may want to be cautious about investing in sectors that are exposed to China's industrial slowdown, such as commodities, energy, or metals. On the other hand, investors may want to look for opportunities in sectors that are more resilient to China's economic challenges, such as consumer staples, healthcare, or technology. These sectors may benefit from China's growing middle class, aging population, urbanization, innovation, and digitalization. They may also offer more stable returns and lower risks than cyclical sectors. Of course, investing in China is not without risks and challenges. Investors need to be aware of the potential pitfalls and uncertainties that may arise from China's economic transition, political system, legal environment, and market volatility. Therefore, investors need to do their own research, due diligence, and risk management before making any investment decisions. If you found this video helpful, please hit that like button. It really helps us to understand what kind of content you want to see more of. And don't forget to subscribe. Here at the Investing Iguana, we're dedicated to helping you navigate your financial journey with confidence and clarity. And guess what? There's plenty more where this came from. Stay tuned for our upcoming videos, where we'll tackle other interesting financial topics like the best investment strategies, understanding the stock market, and how to make your money work harder for you. As always, we're thrilled to have you as part of our Investing Iguana community. Your support helps us keep producing free content like this. Remember, every like, share, and subscribe goes a long way. Thanks for joining us today. Keep investing, keep growing, and we'll see you in the next video. Bye for now.